Today we're talking about tax strategies. Obviously, we all have to be careful. We're not CPAs or accountants or giving tax advice, but just different things that we each do in our businesses to help out with keeping more of your money, basically.
That's what it's about, keeping your money.
That's it, man. We work hard for it, right?
Yeah, that's how the rich stay rich. They know how to avoid taxes.
Exactly. 100%, man. That's the way to do it. And there's a lot of good strategies, and we're in the right field to do that, right?
Yeah, absolutely. And we're not avoiding taxes, right, guys? We're just using the system as it's intended to benefit our
100%.
business.
100%. Yep, that's it. We got Dave Lawson here. Diane's on. Excellent. All right. Well, let's start it off, guys. Today's topic is going to be 2026. How do we keep more of our hard-earned money that we make? Tax strategies or just business strategies that we all use. Cam, why don't we start with you, man? Why don't you kick us off here and tell us what you do, what you have done over the years. We're all going to give some tips. And, again, guys, just to preface this isn't tax advice. Talk to your own CPA. We're not giving you advice, so we have to make sure that's properly disclosed here. This is just some things that we do for our own businesses and for our own personal income. So, Cam, why don't you kick us off, buddy?
Absolutely, guys. And that's a great preface is obviously this is going online. It's going out to the public. So just being mindful, everyone, that we are not certified CPAs. We're not tax professionals. We are real estate professionals. So what I will kind of talk about, and I'm going to be brief because I am not a tax professional. So I hired this out. And that's kind of the discussion I want to kind of talk with the panel about today is how do you go out and find that more advanced CPA or someone that can work inside your business? And it's a challenge that I've had. I've been through a few of them, and everyone it does it a little differently. They have their own strategy, right, to how to do business taxes. What I have come to, and this is just what we're doing here, is my business is ran as an S corp. So everything goes into the business, and then I am paid out of that. That is just the most rudimentary kind of standard way that if you're not doing that, you need to talk with your tax professional and see if an S corp would be the most cost efficient way for you to move forward. Now, with that said, it does limit you in some ways because you are lowering what your personal income is based through your company. Now, like I said, this is stuff you got to chat with your tax professional on. So if you are going to be going out and you need to show a certain amount of income, this can hinder you. But again, if you're able to keep more money, and we're going to talk about this more throughout this call today, you're able to keep more money, make more money with it, and you're able to do more with it rather than just be limited to paying the tax man 32 or 40% or whatever you are this year. So you need to be incorporated. You need to have it set up so that you're getting paid. At least how we have it set up is that I am being paid the minimal possible for my personal income, because I don't need a lot to live. You only generate, or you only give yourself what you need to keep your liability low. The other thing is too, and this is the really incredible part. So this is the actual value that I'll give you here on this call today, is being that we're in real estate, and that real estate has evolved a lot in the last 3 to 5 years in terms of, we are truly now the biggest advertisers on the internet of any profession. You don't have, you do have some lawyers. I'm sure you guys have seen Morgan and Morgan, the largest law firm in the country, right? You see them on TV, you see them all the time. But all of those expenses that they're building into their business are a complete tax write-off. And being here in real estate, I'm not going to give you specifics because I'm not your tax professional, but you need to expand your thinking and think of all of your social media or media in general. All of your travel that you're doing, is it real estate related, or can it be real estate related? As I think all of you know, or most of you know, I have NextGen. We're a coaching group. And when I go to different states or even different countries, you guys, I make it a priority to meet one of our teams locally first. It's my reason that I'm going there, is to meet up and, see the team. And because I have incorporated NextGen, this is part of the business, you guys. Part of my business is I need to go travel to see these teams. And because of that, and I've set it up that way, those can be a complete write-off for you, right? And you can do the same thing. You can have your own coaching group. It doesn't matter if you have coaching clients or not. That's a secret, right? It doesn't matter. But if you have a coaching group and your intent is to be coaching, and that's really the truth. Is, I mean, I'm there coaching people. Dave Lawson, I was in his office here a few years ago. And that's, really the idea there was, Salt Lake City, Park City, the greatest ski resorts in the country. Well, kind of guys, you think about some of the other things that I did after I was done doing my business at Lawson's House. We were, spent a week at Deer Valley. We enjoyed the amazing things that you can do there, but it was after the business was done. So my biggest suggestion, my biggest advice for all of you guys is to look at this as a business, real estate. It's not just you're going to go out and find a client, sell the client. It is a huge, huge umbrella, and you can incorporate yourself under that umbrella and start using those expenses to become part of your write-offs. And since my first year that I had over a six-figure tax thing that I looked at the end of the year and went, oh, criminy, I'm sure we've all been there, right? You get that the first time that you're making a lot of money and you go, oh my goodness, this isn't going to work. So those are just my experiences, is that once I had that experience and got connected with better and better tax professionals, we set it up, incorporated, and then we were building out our incorporations to add more in terms of things that are true business expenses, not on the line, not gray, these are an actual business expense that if we are audited, we can clearly state and show exactly what we were spending and what we were doing. So that is really the secret, is in making sure to remind yourself, like I just said, you can have your own coaching company. And even if you have 0 coaching clients, you guys, that doesn't mean the company doesn't run at a loss, but you still need to be going there. You can't just go there and say, oh, I was coaching agents and you didn't meet any agents. That doesn't work, right? So you can do this with media. You can do this with, it's unlimited. It really is unlimited. Training, media, travel, even so, for example, all of the office stuff, these days when we need to get a new computer, the media company is getting the computer, which is a direct 100% write-off, because it's not a real estate computer. This is a media computer just for doing a real estate media. Those are office expenses that are a full write-off because they are equipment. Equipment is different than, oh, I bought a new computer for my real estate business this year. At least that's how my professional tax accountant has broken it down for me. So as I said at the start, make sure you're going back to your professional. They are the ones that know the laws inside and out. They're going to be your value. If you don't have one, like I said, I'm hoping that on this call today, we can talk about a little more on how we have discovered our professionals that we use personally, and hopefully we can get some great tips there.
Awesome. Perfect, Cam. Thanks, buddy, for your tips. Those are really good. Lot of good stuff there. So yeah, I'll just kick in real quick. Having a good CPA, guys, that's sure you need a dream team. I think having a really, really good CPA, it's really hard to find, to be honest with you. You might go through a couple before you find the right one, but that's really critical. You need one that understands all these dynamics, which we'll get into a little more. We'll get
and you also got to be willing to pay them. That's right. Sorry, Dennis, didn't mean to cut you off there, but that was one of my big hangups for the first 4 or 5 years having a CPA. I wanted to pay him $60 a month just to run payroll and stuff. Guys, you can't expect a real professional to be, thinking about you and digging into your business if you're only giving them $60 a month. So keep in mind too, they'll save you a lot in the long run, but you are going to have to pay them for their business or for their, for their help.
Good idea, Cam. Good tip. All right, so we have 2 guys I really want to hear from, John Pacilio and David Johnson. So let's first start with John Pacilio, if you don't mind, John, because you're one of the sharpest guys I know in business for so many different money, wealth building strategies. We all sell houses. We all want to sell more, but you're one of the sharpest guys I know. You and David Johnson, kind of stand out right here. So why don't you go first, John, and then we're going to jump to David after that.
All right. So I married a CPA. That helped out a lot. She does my book. She's sort of a retired CPA, but she works for a non-for-profit. But I can tell you, the QuickBooks files that I have are incredible. I can go back years and do charts and graphs and that sort of thing. Probably could do a better job reviewing those more often. But I think that's where it starts. Get yourself a good QuickBooks. If you're inputting your receipts and categorizing them, that'll really help you on your business. Start with that. And then beyond that, she's not an expert at, LLCs and, when you buy, I always tell her at the last minute, I said, yeah, I just bought a rental property. And she's like, oh boy, here we go. So I'll bring in a third party person just really as a consultant to tell us how to structure that and work out the paperwork and give her advice on how to put it into that QuickBooks program because you need to keep good records. One quick thing I did was, and you brought it up, Cam, payroll, pay yourself. But we have a regional bank here for like 10, you can have 10 employees and it costs like maybe $60 a month, something like that, to get a payroll service. So it takes me about 2 minutes to log in. I do payroll for myself, my bookkeeper, which happens to be my wife. Sometimes I employ my kids for different aspects of the business. I'll pay them. That's a good tax savings strategy as well because they don't pay much tax, and you have a write-off for that if you have kids involved in your business. I have a full-time assistant. She gets a check every 2 weeks automatically, and I think for all the payroll, all the state documents that they submit for me on my behalf, it's like $60 a month. So it's well worth it to have that done, and you get all the reports. So I take the reports and send that to the accountant when needed. Make sure you're doing quarterlies payments. You don't want to be caught behind the eight ball. Make sure you're keeping up on that, and you don't want penalties if you're making too much money on that. So those are some of the basics. But beyond that, one thing I did December 27th, which worked out well for last year, because I had a pretty strong year last year, was I bought an SUV that was 6,000 pounds. So use that technique. All you have to do is log into Google it or ChatGPT at the end, whenever you need a car. Make sure it's 6,000 pounds, and you can do a bonus depreciation. It allowed me to write off the entire vehicle, which was in I don't know, $64,000 off your top line. So if you want to, and you're using it, my business bought it, and I'm using it for business every day. Just make sure that that one's out there. Travel you hit on. One thing I've done is I bought a commercial building, and I partnered up with my mortgage guy. He has a floor, I have a floor, and then we lease out to a restaurant downstairs. And I have I pay myself rent, out of that, and he gets part of that, and his business pays rent in. So it's a write-off to the business as well. All legit, all your office stuff, your computers, if you have family involved and they need a computer, guess what? You can buy one through your business. So
Yeah, that's great.
just a few things, a few bullet points for you.
Great tips, John. And one thing, guys, that I'm doing this year, my son just turned 19. I'm going to set up a Roth for my son, and I'm paying him just to set him up with, good Roth IRAs, guys, is a good. Some people are mixed on 401ks and Roths, and we'll get some opinions on that. But a Roth's a good one. It's post-tax money that when you pull it out later, when you retire, you don't pay taxes on it. So you pay taxes up front, as opposed to a 401k where when you pull money out when you're 60 years old or whatever, you get taxed on it like ordinary income. So that's a big one. David Johnson, let's go to you, man, because I'm dying to hear what you say about this.
Hey, Dennis, I'm heading to an appointment, so I wanted to can I just talk for 3 minutes? Because I'm going to go to an appointment, but I was going to say a couple things real quick, but I want to listen in because I can't wait to hear what David's going to say. But I wouldn't be able to speak after that. So
go for it, Dave.
One of the things you said do a Roth IRA. So what I've done, not when my kids are 19, I started when my kids were very young, and what I would do is I would make them actually do some work for the business. And then I would pay them, and I would pay them the exact amount of money, whether it was $6,000, $6,500, $7,000 a year. I'd put it in a Roth IRA. And right now, my kids have hundreds and hundreds of thousands of dollars by me just doing that. And when you look at it, if you just say, I'm going to just put in whatever the Roth is for my kids, now it is not a deduction for them, right? But if you pay your kids, it comes off the top line of your income because it's an expense. They pay no taxes because they're under the adjusted gross income level that they have to pay taxes, or and even with kids, they don't even have to do tax returns. And it will build them. It can be in the millions of range, and it's all tax free to them at the end. So that's one thing. The other thing is, as real estate professionals, you know, I tell people two things. A write-on is better than a write-off, right? So we want to focus on making money. I don't like paying taxes, but I can tell you when I paid over $1 million a year, a couple years in taxes. And you know what? People go, oh, that's terrible. And I go, no, that's the best years I ever had. So think about that a little bit differently. We live in a wonderful country that allows us to do a lot of things. The next thing is when you're doing tax planning, there's always little things that you can do. Like in Utah, if you pay in December or before the end of the year, if you pay some of the tax and some of the stuff up front, it gives you a big benefit. That's where you have a good CPA. That's important, but this is the most important one. We're in a business that we can make we have to go to school for 120 hours, and then we can get a license and we can make more money than any attorney, any doctor, any professional anywhere. That's what we are. That's who we are. That's what we're able to do, right? So if that's the case, stop living off of your commissions. If you want to build wealth, so the rule I had is I make money, 10% goes to a charity or tithe or whatever it is I believe giving back, that comes off the top. The next 10% is that money goes into something that builds wealth, right? And then usually that's like long-term stuff. And then 10% goes into like short-term, like I'm going to buy like an investment or something like that. And then there's 70% left. Out of the 70%, I put 25 or so 30% into my estimated taxes, and I live off the rest. And if you do that over time, your wealth will go up. And the thing is it's a little painful for the first year or two because you know what you've been doing, you get a check and maybe you put something away for your estimates, maybe you don't, and you live off of everything else. And you can't do that. And so that's just what I wanted to share. So I'm just a few minutes away from my meeting, so I'm going to turn it over to David.
Great tips, Dave. Thank you so much. Hopefully you guys are all taking notes because you're hearing some really, really good tips here. David Johnson, you're up, buddy. I want to really hear what you got to say. And Dave, before you start, you're at a different level than a lot of people here, including myself. So maybe you can give high level stuff and maybe some, brief low level stuff for agents, not low level, but agents that are just starting off that are not making hundreds of thousands a year.
Yeah, of course. I think like the first thing, which is the biggest thing, is buying a short-term rental house. That's going to be the biggest powerful due to the SCR tax code that they issued out. If you're renting a property under 7 days, and it can't be in your primary LLC, S Corp, whatever the case may be, because it's actually going to hurt you if you put it inside of your S Corp and not an LLC. So LLC should be underneath your S Corp because you want it all to funnel up. So with it funneling up, you're going to get a different level of tax benefits on that short-term rental. And the other thing that a lot of people don't know is that if you don't have a short-term rental, you should get one. even if you got to fight everything in the power, because you as a real estate agent, there's actual a tax code, and I don't know all these codes at the top of my head. I'm quite sure I can look it up. I think it's 199A or something close to that. But basically, if you work at least 750 hours throughout the year as a real estate professional, whether you're dealing with investment, you're building, whatever the case may be, you can write off your losses on your rental properties against your earned income as a real estate agent. So that's going to be the most powerful thing, because again, if you own a short-term rental, the easy thing is that you don't have to show that you make any cash flow on that, and you can do a lot to write you off. You can hire yourself as a manager, you can write off your trips, you can do a lot of things on it. And then it doesn't matter if you show that you made minus $50,000. It really doesn't matter. But now you're able to use that towards your S corp, and you're going to be able to get a bigger tax advantage with you doing that. And it actually hurts you a lot worse if you keep it in your S corp and not a subsidiary LLC, because then you're going to have to pay a lot more taxes when you go to sell that property if you're not doing like a 1031 exchange. So that is like the biggest thing that I tell everybody to do, that you need to have that done. We don't have enough time for me to talk about how to set up a holding company and put all the money up there and all this other stuff. I just wanted to give, like, while everybody was talking, I wrote down a few things that I think that I would want to know. And because I feel like knowledge is power, and you have to do your own homework on everything. You never take a person's word for anything. The other thing is that they actually have some that's called a cash balance plan, and you're allowed to set it up to $200,000. And if you do that, say that you make $600,000, right? You can take $200,000 out of that. Your CPA can put it into a cash balance plan, and you won't be taxed on $200,000 as long as you set it up right and it goes over there. So that's another way you can avoid taxes as much as possible. The other way, I know Cam was talking about that he set himself up on an S corp and he's paying himself on payroll. Now, I don't know how much everybody wants to pay them on payroll and stuff like that, but each state has a cap, and you want to stay underneath that cap so that way you can get all of the benefits from actually paying yourself on a W-2 salary. So for Georgia, it's $186,000. And that means that I'm paying in for like all the payroll taxes, for Social Security, I'm paying in for everything. But the other advantage that you have some on that too is you have something that's called PTET. And basically what that means is pass-through entity tax. And if you do that right, you should be able to, like, if your tax bill is $55,000, and if you pay yourself like you should, you can write off around $25,000. So that $25,000 is going to get paid, and it doesn't matter. But on the business side, you're going to save a lot more money whenever you file your K1 at the end of the year to make sure that you're saving the type of money that you need to save. Somebody else was talking about it too, about hiring all your kids. So me, it's great because I got 5 kids, so I get to write off a lot. But if you have kids, you can pay them up to $15,000 each year. On top of that, setting up a Roth is super powerful for your kids and for you. And for those of you that don't know it, you can hire somebody to set all this stuff up for you. It's totally up to you. You can hire somebody to manage the Roths and stuff like that. Like I got a guy here, he charges me 1% of the earnings. You know, I don't really care. I'll just pay him because he's making me money. It's not a big deal for me whatsoever at all. But that's something that's super powerful, especially if we're talking about, hey, I want to set up a generational wealth plan. I want to set my kids up for the future. Because I worked really hard, and I don't want my kids to work as hard as that I'm working, and I'm quite sure everybody's the same way. If we want to break like the cycle, then the cycle is only broke with the actions that you do every single day. If you're not willing to perform these actions, then your kids won't, and then they're going to be stuck in the same cycle that you got stuck in. Only a few of us is going to be smart enough to get out of it, and if you really want to make your way out of it, then you got to set everybody else up for success. So like a CFP is super powerful, and they're able to set the Roth up, they're able to set everything up, and they can actually show you, because if you're making a certain amount of money a year, you won't be able to be eligible for a Roth. So a lot of people don't know that. Like, say that you're coming close to $500,000. You won't be able to set up a Roth for you. But there's a different program that you can set up for you that's still going to help you with the tax side of things. So you have to be kind of aware of how much money that you can make versus what it means for a Roth, and understand what a Roth is. But buying houses, That's probably been my number one goal that I've always done because I like it. And in my head, I'm like, why am I going to pay the IRS money when I can just put it into a house and it's going to pay me passive every single month? And the way I do it is you can burr it out. So finding specific houses in specific areas that's undervalued, you can add value to it, your value add. And then once I do the 1031 exchange, I can put a secondary loan on it and pull all the equity out. Now, the key part to this is that you need to get a equity line on the property. So that way it doesn't really matter. It doesn't change anything. And when I do the 1031 exchange, my cost basis is still the same. So it doesn't matter. And the 1031 exchange is a really powerful tip. I love explaining this to everybody because I think if you do it right, you can get a lot of money. And again, the IRS can't tax you on a loan. You know, that's the way it's been forever. So the more debt you have, the less taxes you're going to owe. Having debt is positive. You just got to have the right kind of debt. And if you don't have the right kind of debt, then you're failing, because you always have good debt and then you have bad debt. You know, trucks, you know, I think I heard somebody said that they went out and bought an SUV that was 6,000 pounds. That's great. I mean, for those of you that saw me, I drive a big ass truck. I parked it out front of the hotel we stayed at in Nashville. It was there. But I didn't buy it because I wanted it. I didn't buy it because it was big. I bought it just because I needed to write off money. So I found a truck at a certain dollar amount because I can write off 100% of, that's called bonus depreciation. So I can write off 100% of the value the first year. So I either pay taxes or I buy a car. But I did want to circle back on the CPA thing. A lot of people have questions about, hey, how do I find the right guy? It took me years, and it took me a lot of people. I interviewed a lot of people. What I can tell you is that every CPA is going to tell you the easy way out, which is go and buy a car. If your CPA is just telling you that you need to go buy a car, a truck, or an SUV, that's the worst mistake of your life. And don't go to that guy, because I talk to him every quarter. Every quarter, me and my accountant meet up. We do a Zoom call. We go over the books. We kind of analyze everything, because you should really be understanding what you're doing every single quarter. And that's going to kind of help you prep for everything that you need to do in the future too. A lot of people wait to the end of the year, and then you're kind of screwed. Then you're rushing around, then you're trying to figure out what you really need to do, how you need to do it. But having that CPA that's really good, that's really smart, that knows what he's doing, that knows how to work like the tax code, is going to be somebody that's going to be successful to you. And me, I just went to an area where I lived that the home prices was super high, because again, if I know somebody, then maybe he can send me clients too. So using a CPA to funnel into your business is the other thing that I wanted to. I wanted a guy that only wanted to work with higher end people. So for him, he doesn't work with you unless you make over 250K. So now I know that I got put into a group of people that is not really ultra high net or anything else like that, but he's only dealing with the people that can afford homes in his specific area. So now I got put into this circle. That way he's going to help me. I'm going to help him. It goes round and round, and everybody wins at the end of the day. But I think the CPA is the biggest puzzle, because taxes, you have to know the tax code and you have to read it. And if you haven't went through it, then I encourage everyone to take a 1031 exchange course. It's really powerful, and the more educated you are, the more clients you're going to have, and the more respect each person is going to give you, once you can just talk about these things, and once you can educate them like, hey, this is what you need to do. For like the smaller things, for those of you that don't have a physical office, you have the Augusta rule that you can do. You can write off a certain percentage of your house, and that right there is another tax code that you can use to kind of lower what your taxable income is going to be. But the most powerful tip, I'm telling you, that once you get past $250,000, you really need to be setting up a holding company. And the reason behind this is because, I didn't set this stuff up, so I can put you in contact with the people that I talked to that did do it. But a holding company, if you do it smart, you're going to put yourself on a certain amount of money. And then if you own multiple houses, those houses is going to be paying a dividend straight all the way up to the very top. And if you structure it right, you won't pay any type of taxes on the money that's flowing up to your holding company. You have to structure it right, because if you don't structure it right, then there is tax implications that you have to do. But there's a way that you can set on where all the dividends flow all the way up, so you're still making money. It's still flowing, but you're setting it up to basically where it's owing the holding company. The holding company issued the loans. The holding company's doing everything. And like me, I will make the holding company issue out loans every year for each individual LLC that we have. So therefore, I get another tax write-off for the interest payments that I'm paying over to the holding company. So there's a lot of ways that you can structure it to make sure that you're lowering it. The idea behind all this is, how much do you really want to pay? Because I can dig into this really deep, but how much do you need to bypass before you're happy, before you don't have to pay anything? Everybody has to pay in. It doesn't matter. I've never got money back since I filed taxes ever. Even whenever I was in the Army, I still pay taxes. I mean, there's no way around it, but you can set up a lot of different entities and you can structure it and set up multiple different businesses structures, because you as a real estate agent, I know you're not just a real estate agent. How many times does seller call you and then you become an advisor? That's a whole different type of business. I have sellers that call me, just ask me about stupid questions. Time is money. So I need to be billing that, and I can be billing it to basically a dud LLC. And the dud LLC is not making anything, but it's going to weigh out everything when you funnel it up to the top. And then spouses. Everybody has a spouse. Well, I don't know if everybody has a spouse, but hopefully, everybody will eventually have one in the future. But even if your spouse works, if your spouse does not work, there's taxes there that you can be saving. If your wife doesn't work, she stays at home, you can funnel stuff over to her too. I mean, everything's there. Like, there's a lot of things that you can do, but I think the biggest thing is LLCs are meant if you're making under $30,000. If you have an LLC, then it really doesn't do anything for you in terms of the tax side until you incorporate it to an S corp. After 30 grand, you should have an S corp. And then that's when you should start considering how much that you want to pay yourself. And that's kind of where it all starts. And I do the same thing with all the agents here in my office. I kind of talk to them and I tell them, like, hey, after that 30K mark, then you need to start incorporating yourself. Then we need to talk about it. And I bring my CPA in once a year for the whole team. So he'll come in, he'll kind of advise them and kind of talk to them. But it all starts with, you can't be an expert in all avenues, but you can have people in your back pocket that are experts in all these corners. But housing.
Yeah.
David,
That's great stuff.
David, when you found that CPA and you were interviewing all the CPAs, what were the questions that you were asking, or what were you trying to see what they knew, or kind of give me some insight on how you chose this guy outside of the fact that, he only worked with high net worth individuals?
I'll tell you, the first thing I went to him, I said, hey, if I made $1 million, how would you help me avoid all of my taxes? Which, of course, it's physically impossible. Well, it's not, because a lot of people, if you spend the time, you can structure it right. But basically, that is the question that I wanted to ask. I said, if I make $1 million, how can you tell me what to do to avoid paying taxes? And then I was just writing down everything that they were saying, because I didn't want stupid things. I didn't want a CPA that wanted to be lazy. Like, I wanted somebody that would actually understand the tax code and help me understand these. So once I asked that question, he was like, well, this and this. And that's when I learned about the PTET. I didn't even know anything about that. I didn't even know what it stood for. But then I realized having an S corp was powerful. I can push taxes down there to write it off on the business return. That's when I kind of learning about all these things. But also, self-education is the most powerful tool. You should never hire somebody when you don't know what the role is. So that's why whenever I went to college for taxes. I went to college for business, marketing. I was stupid. I went to college for 12 years. And to be honest with the group, I didn't even finish. But I got 12 years of schooling. But I bounced around to each thing because I wanted to know just enough. So whenever they started saying something or they was questioning, then I can tell if they was lying to me or not. Because if you don't know what somebody's doing that you're hiring, and if you don't know how to do that skill, then you're lost. If that person ever quits or leaves, then you're screwed. So you have to understand the business as a whole.
Yeah, good stuff, David. I appreciate it, man. Thanks for your time. I encourage everybody to come back and listen to this. This is a really good webinar to really focus in on. Let's move around a little bit. Just real quick on David mentioned the real estate professional status. I am my CPA, which I have a really good CPA. He did this 20 years ago. So basically you have to work the rules are roughly, again, we're not giving you tax advice, but 750 hours per year and 50% of your working time in real estate. And then you could write off your losses against your income, being a real estate professional. Okay. So that's really key, guys. So, talk to your CPA about it and see which way you want to go. Let's keep moving on. Craig Lurch, you're next, buddy. Let's hear what you got.
First of all, David, I love hearing that you started so early with your 5 kids and all that stuff. It's some great stuff. I had some great notes that are going there. I'll be honest with you. We cleaned my shit up about 3 years ago, or really 5 years ago when I came to EXP, because I was playing with everybody else, doing everything else, and had too many partnerships. And one of the things I realized is partnerships suck your energy out, and you're doing a lot of work for other people. And especially if you're not getting all the benefits of it, some of it weighs off. So I'm going to give a caveat. Watch the partnerships you get into, and or get them structured a certain way that you can control your write-offs to it versus somebody else controlling the outcome to it. I had gotten burnt on a lot of taxation stuff when I left some partnerships that you didn't realize, because there's a lot of back depreciation and all that stuff that it can come and bite you. Even if you just walk out of the company for $0, you're still going to owe the tax on that number of that K1. So be very, very astute if you're getting out of a business. One of the things that we did is we met him on here, Matt Palmer. If you're looking for a way to run your business a great way, Matt Palmer is a great business coach. He's also an EXP guy, but he also focuses on how to run your business through I'll say a virtual bank. We've got banking of our own. It stays at home, but all my money goes to a virtual bank, and every time it hits the account from EXP, it divides into different percentages. It goes into payroll for myself. I do follow that rule. I do pay myself the taxes the maximum. I think it is $157,000 in the state of Pennsylvania, but whatever that is, we pay those taxes every 2 weeks. It comes out payroll. Number one thing that goes out, and then my staff also gets paid through it. The only person that doesn't get paid through it is my virtual assistant. And make sure you get, I think, what is called the W-8 for them. My accountant was real astute of doing that. Also, we're real astute in making sure we get all the 1099s for anybody that makes over X amount of money when you're doing it. So when you're filing your taxes and you're turning in 30 other 1099s, the IRS likes seeing that. That kind of keeps them off your butt, that you're just expensing things that aren't supposed to be there. So the bookkeeper that I have, her name's Teresa. I got introduced to her 2 years ago. I had 3 other bookkeepers in the past. They all sucked because they were all last minute and they didn't do it right. She stays on me. She's virtual. She costs me about 350 to 400 hours a month. She is out of Texas. She does every monthly P&L. Everything that comes in the office, everything that comes into my account, it goes right into my QuickBooks. Every receipt I spend, I take a picture on my phone. It goes right into my QuickBooks. So each month we're balancing and going through everything all the time. That we're not able to get off track. If you get off track and piled in a box, like Cam said, and like Dave said, you should be meeting quarterly. And that's what we're doing. But we've gotten it down that I get a report once a month, profit and loss, and things of that nature, where things are going. So those are the number 1, 2 things I'm going to suggest. They're not real expensive. Get a good CPA. Mine's in Pennsylvania. Get a good CPA. I had 2 that sucked. This one is really good. He's a single proprietor guy. He isn't a big company. He talks that away. And we meet in June and July to start talking about what we're going to do for the rest of the year as far as taxations go. Because then you have a plan of where you're going and what you need to do. And you have a projection of where you think you're going. All right. If you don't have a plan, you're just driving, you're just out in the inlet by yourself. And it sucks. Trust me, been there, done that. Don't want to do that again. So number 1 is what these guys said. Get more depth on that. Number 2, if you need a coach for a while, you can get them, for a month, or you can do half month, whatever it might be. I got Matt Palmer's information. And then number 2 is if you need a bookkeeper, I got her. Matt's actually putting Teresa involved with his business also, so you can kind of get the 2 of them together. And then they also tie into a virtual bank that All the money goes in, all the money comes out, and it's really nice when automatic payments are being made and it goes right to your bookkeeper. You're not sitting there being stressed with noise. So just something very quick. John has his wife doing it. I think Dave was mentioning his wife looks at it a little bit. My wife don't look at it. I run my business the way I run it. My wife's got another other job. She don't want to be bothered with it. All she wants to know is what money's coming home and what she can spend. Welcome, Mrs. Lurch. So,
Awesome.
if you need those numbers, I'll be more than happy to send you Matt's number. I'll put it in the thing, give him a call, and get at it. You want to stay out of trouble? Pay somebody to keep you out of trouble. It's also great that if you're going to go buy, like you want to go invest into something and buy it, and somebody's trying to sell you something for your business, it's great using a third party. I'm not allowed. I need to put it by my business coach and my advisors. So now you got a board of directors that you can't knee jerk and just go say, here's a $10,000, $20,000 great idea. It gets you out of the emotional. It comes back to the book, The Road Less Stupid. If you haven't read the book, The Road Less Stupid, listen to it. It's called the Stupid Tax. The dumbest thing you can do is emotional. If the second you walk away from it, think about it a little bit. There you go. Why do you think the prettiest and most shiny cars are in the showroom? They want to sell them to you because they're going to get you emotional when you're in there getting work done in your car, and they're going to talk you up. So those things, Road Less Stupid, and I'll put Matt's number in there. He'll keep you off stupid.
Thanks, Craig. That's really good. Great book, by the way. I read that a few years ago. I need to reread that. Guys, you're probably hearing a common thread here is have a dream team, right? CPA, good financial advisor, right? Those two need to communicate with each other, by the way, for, any kind of retirement plans you do, etc. Right? So it's key to have this dream team or a board of advisors, board of directors, like Craig Lurch said. Is Ross Stout? He left. Pete, let's go to you, buddy, because I want to save you for last because you're an agent just like all of us, and you've done extremely well. And I know you're really smart when it comes to money. So why don't you give us some tips, Pete, that you would use for, high level agents and maybe just every agent really, what are the basics that every agent should be doing to save money on taxes and to have good strategies?
Well, I think, the basics of this is that most agents are good with money. Most agents never pay the IRS. So don't be one of those agents. So my two tips are this. Number one, set up 2 or 3 money market accounts. Yeah, different banks. So they're all covered by FDIC. And then anytime you get a commission, have it go into one money market account and then move 15% from marketing into another money market account. And that's your designated marketing account for the year. Right, so you have a plan for marketing because that's the key. It's what's the saying? Early to rise. I forget the saying, but anyways, it's like you want to work like hell and you want to market as much as you can. That's the key. So when you do that, put another money market in place. You take another 30% out of each check and put that in there for the IRS. So you don't have to think about it. It's there every time you get a check for the year. It goes in there. If you come out ahead because you have an S Corp or LLCs or things funneling up, like David was saying, and I love that, what David said, that it's going to be a bonus for you at the end of the year. And somebody's going to have a good Christmas. You can buy the G.I. Joe with the Kung Fu grip and all that stuff, right? But I think you want to have multiple bank accounts that you manage. You don't want to leave too much money in there, but you need secure money to run your business. So I like what Lurchy was saying. Any bookkeeper or financial guy will advise you on that. Don't just live paycheck to paycheck. You have to live in abundance. So here are my 2 big tips. My other tip, I like the one that David said with, understanding what you can pay your kids. I pay my kids every year. I've had Roth IRAs set up for a long time. I have 529Es set up for their college funds, and I keep putting stuff in there. So that's another thing you can do. But the biggest thing you can do, if you're making significant money, and let's say you're making above 250, all right? The key that everybody should set up, especially when you get in your 40s, is a vehicle called the defined benefit. And a defined benefit, otherwise known as a DB, and most accountants and financial planners never ever mention this to you. I don't know why, but they don't. It is one of the greatest vehicles you'll ever have in your life. So you set up a DB. The DB acts like an annuity or your own personal retirement. So every year you can take money out of what you made. Let's say you made 500 grand or 400 grand. You can put, based on your age, as much money as you want into that defined benefit, and it grows tax-free. The only time you get taxed is when you take it out later in life. You can't take it out before you're 58 and a half. Or maybe it's 59 and a half. It's right around there.
59 and a half.
Yeah, 59 and a half. And then once you take that out, you're going to be in a lower tax bracket. That fuels your retirement. And it goes in there tax-free. So it's either you pay the government. If you're in California, you're paying the government if you're making decent money, around 48% to 52%. I'd rather keep that money, put it into an investment account, tax-free, that grows and makes me money and secures my future, and I get to enjoy it in my retirement. That's why we're all doing this, and to make our kids' lives easier, our family lives easier. So that's a big thing. How many people on this call are aware of what happened last June? One of the greatest things ever got put into legislation. Does anybody know what it is? It's called the OBBB. One Big Beautiful Bill. And the One Big Beautiful Bill, where I think I was the only agent that actually did physically a backflip, allows real estate agents to buy investments and get 100% depreciation in the first year. So let's say you have a banner year and you make $1 million. You can go out, and let's say you have no write-offs, hypothetically. You can go out and buy an investment property for $1 million, and that will write off right against your ordinary income. So you pay zero tax. Where normally you would pay 50% tax if you make $1 million in most states. So right there, you save 500 grand. So did you buy the investment opportunity for $1 million, or did you buy it for 500 grand? And that's the big, beautiful bill. 100% depreciation first year on an investment. The old way.
Sorry to interrupt, Pete. Pete, let me interrupt you for one question. Pete, let me interrupt you real quick. So also, you don't have to buy $1 million property and put down $1 million. You could buy it with minimal money down, right? That's the key, guys.
You can buy it 25% down. So you can buy a property. Say you buy a property for and you put 100 grand down, still able to write up 400,000 that first year against your ordinary income. So if you made 300 grand, you can write off 300 grand. Guess what you pay Uncle Sam? Zero, you guys. Yeah, you can buy trucks, you can buy other stuff, but this is best because it's an investment. And if you don't believe me, just go to ChatGPT and chime in One Big Beautiful Bill with all the real estate benefits for real estate agents and how 100% depreciation works. It's the greatest thing ever created, ever, for us.
It's great stuff.
To keep our wealth. So that's my tip.
Awesome, Pete. I love that. Guys, owning real estate, you could do depreciation. Typical is 27 and a half years, I believe. So, you see all these real estate people that pay zero taxes and everybody complains about it, right? They're just using the system, you guys. They're not ripping anybody off. If they get audited, they're going to pass. So, it's just buying real estate, I think, is the best investment ever, right? Especially like a rental property. You get in the basic level, buy yourself a duplex, right? You get your tenants buying you the house ultimately, and you get the write-off every single year off your ordinary income. So that's a no-brainer. S Corp, I get a few notes. So S Corp election, like David, you were saying, if you make over 30,000, that's when you should really consider an S Corp. Separate your business finances, clean your books. Basic write-offs, your vehicle, right, guys? You have your Hummer tax, which is the over 6,000 pound, basically, the 179. That's a big one if you're making significant income. Your home office, all your marketing, of course, any education that you do, coaching, masterminds, all that kind of stuff, traveling for business purposes, those are all write-offs. Advanced stuff like David, I wrote this down, the Augusta rule. You get to rent your home for business tax free. But again, guys, we're not giving tax advice. Yeah, we're not giving you tax advice. Check with your CPA, which is critical, right? Before you do anything. Roth IRAs, I'm a big guy. Defined benefit plan, like Pete said, that's great. Cost segregation, Dave, you mentioned that. The real estate professional designation, I think that's really big, guys. If 50% of your work is in real estate, 750 hours per year, and 50% of your work time's in real estate, which I think most of us are in this thing. You can tag yourself as a real estate professional, and that adds huge tax benefits. Yeah, that's kind of what I have to say. Anybody else want to chime in, or do we have any questions from anybody?
I have,
Anybody have
Really
a
good
question?
stuff, everyone.
I have something real
You can
quick.
unmute yourself.
Oh, I'm sorry, Cam. So real quick, and I may have mentioned this before, but I have two kids in college. They're coming home, right? So I have one from IU and one from Purdue. They hate each other, but those colleges do anyway. So I have 6 kids, so I'm with you. So this is something you can do for your clients too, but we can take advantage of this. A long time ago, I bought I'd call it a vinyl village shack kind of place, and those values have gone up a lot, right? But I bought it at, let's call it 150. You can buy something for 150 here years ago. Now it's like almost 400. But over the years, I've leveraged that house, and I think David brought this up, where I pulled money out without getting taxed on it by refinancing it. And I use that for college. So right now I've got it at a higher level. My renter's paying it down like clockwork. And I've got another 13-year-old that he's gonna use that same house to leverage his college, or a lot of it. So beyond the 529. So that's a good way to do it. I think we brought that up before, but I'm practically using it just with one house. So if you can teach other people to do it, that your friends that have kids, you're going to be a hero, because it feels pretty good when you pull that money out and pay for college. Just thought I'd bring that up.
Yeah, great.
Yeah, and one thing, Dennis and everybody, one thing that we haven't talked about, I thought for sure somebody'd bring up. I've been listening and I had to chime in. You guys, their government gives us the biggest gift, and it's when you sell your primary home that you've lived in 2 years over the last 5 years. If you're single, it's $250,000 of tax-free income. If you're married, it's 500. So I'm going to give you a story. I told my niece when she was about 25, every 2 years or every 3 years, sell your house, move up to a slightly better house. And she's living right now in California in a $1.8 million beautiful house on a teacher's salary. How did she do it? Because you make $100,000 or $200,000 on a house every time they appreciate. You can move and think about it. I had a house that I didn't do that. I didn't listen to my own advice, and I made way more than $500,000 on the house that I had. But let's just say it's $500,000. So I sold that house, and the first $500,000 was tax free. So do you understand what that means? I have to make between $850,000 and $900,000 to put $500,000 in my pocket after tax, right? So tell your people about this. And not only that, don't just you do it. Go back to the people that bought a house 5 years ago and say, hey, John, I noticed you had this house that we did. How's it's going? Have you ever considered cashing in and taking $400,000 of cash-free money? What do you mean? Well, you can sell your house and move up. Well, I don't want to because I have a 3% interest rate. Well, what if you made, so 400 grand, that would cost you $750,000 that you'd have to make to do that. So you pay a little bit of tax, but not very much on it. I mean, interest. Now the interest is deductible, and you have a nicer, better house. And at the end of the day, you can, and then you start over. So your new house starts again. So these are things that you can not only do for yourself, but when you explain the benefits to everybody else, all of your buyers and all of your sellers, and you're a true advisor, that's really where you can win. And, you know, especially if you can, you know somebody that did it, or you understand, or, you know, if we asked how many people have utilized this that are on this panel or whatnot, all of us have. So just do it. Okay.
Yep.
I got to leave. Thank you.
Good tips,
And,
Dave. Hey guys.
Also,
Oh, go ahead.
there was one thing I forgot to mention. It just hit me in my head because I don't pay for it, but I'm quite sure everybody else does. I know everybody in here probably has a health insurance policy. I mean, everybody has to have, you know, at least a level of coverage so you can go to the doctor, stuff like that. And I know that EXP offers a lot of stuff too, but I want y'all to know that there's a section 105 that you can write off everything that you send out in terms of payments if you pay for any type of health insurance. All you got to do is make sure that the payments are being sent out through your S Corp. As long as your S Corp is paying it and you're providing health insurance policies to your family, and it has to be your immediate family, you can structure it for a business too. So like something I'm working on for 2026 is I'm going to be providing health insurance for every agent that works inside of our office and every employee, because I get to use that to write everything off. So instead of paying it in, I'd rather create something where I can have a lot more people that want to come and work in our office because I'm offering them free health care at the end of the day. But for you with families and stuff, section 105, it's called HRA. You will be able to write off anything that you spend for your health insurance.
Yep. Good tip, Dave. That's awesome. Okay, guys, top of the hour. Our mastermind's coming to an end. I want everybody to, I have a challenge for everybody that's still on here. Invite 2 people next week. Okay. Let's ramp this thing up. There's so much good, valuable information here. Everybody on this call right now, I want you to invite 2 people. That's the challenge. Okay. Can we all do that? Thumbs up. Let's do it. Let's ramp this thing up. Okay, guys. Thanks. Great mastermind. Thanks for everybody's tips. This is very valuable, and, you know, rewatch this, people. Okay. We'll see you guys next week, man.
See you guys. Great call.